Hello, I'm Peter Towers, Managing Director of ESS BIZTOOLS. Welcome to this overview on three-way financial forecasts and why they are so helpful for accountants. Because what they do is enable the journey to be summarized. The journey starts with the directors and the leadership team deciding on a business plan or a strategy, which obviously includes the vision for the business, how many people they're going to be employed, where the business is going to operate, what it's going to sell or produce. And then all of that needs to be dumped into a budget so that the directors and leadership team can then analyze what the profitability will be when the ideas that have been reflected within the business plan are incorporated within a budget. Now that looks okay. And for many accountants over the years, that's all we used to produce was a budget. But I think the most crucial document is the cash flow forecast. What's all this mean in cash terms? Because once you put the budget into the cash flow forecast, a number of other issues come to the fore, don't they? Debtors days outstanding. There's a lot of businesses that are not able to collect their debtors on a 30-day basis, which traditionally was the way budgets were done in Australia. You know, we just assumed that everyone would pay in 30 days. Well, that's not correct. Some businesses are getting paid in 80, 90 days average. What are the creditors' terms? You will have some clients who have to pay their creditors within 7 days, 15 days, most definitely 30 days. So what effect does this have in the cash flow forecast? The other big item in cash flow is inventory, especially if your client's in a retail business and they're going to build up for the pre-Christmas period. What's that going to cost them in their cash flow from that investment in inventory? Or will the leadership team be able to negotiate more favorable terms with the suppliers to delay making payments, 3-month payment terms, 4-month payment terms, or what have you? The next area of concern is the capital expenditure budget. Within the business plan, the directors may have resolved to spend $650,000 on new premises or new machinery or a new project. This is now going to be reflected within the cash flow forecasts. The business's current loans also come into effect, as does the business's current overdraft limit and the businesses or the company's philosophy on payment of dividends. There's a number of matters that are all coming into consideration in the cash flow forecast. And what this document is then going to show is there forecast to be a shortfall? And then what is the directors and the leadership team going to be able to suggest to overcome that cash flow shortage? It might mean that the company needs to look seriously at raising capital, either under Section 708 of the Corporations Act or as a crowdsourced funding equity raising company. In our webinar on Friday, the 26th of June, Paul Barnaby is going to take you through this part of the process where he can show you the great flexibility of the Plan Guru software to enable you to calculate these types of forecasts for your clients. And then Arthur Ackers, the operations manager of Equitize, one of the ASIC appointed crowdsourced funding intermediaries, will then give you an overview of what's involved in raising that capital so that that funding gap within the cash flow forecast could be filled with capital being raised from the public. I look forward to you joining us in this free webinar on Friday, 26th of June at 12 noon AEST. If you would like a copy of the link to the recording sent to you, please register for the webinar so we know where to send the link so that you can watch the webinar at a time that is more convenient to your lifestyle. Stay safe and have a great day. And I look forward to communicating with you in the webinar that we're going to produce on Friday, 26th of June at 12 noon AEST. Goodbye.